If you have seen The Big Short, you're gonna love our next guest. He was in the movie and the book by Michael Lewis. We have Danny Moses on the show. He is a fantastic, legendary investor. I had a blast sitting down with him. We talked about the gold trade, silver, what asset prices are gonna do this year, where he sees the biggest opportunities in the market that no one else is paying attention to, and what the next Big Short could look like. This is a fantastic conversation, and I think you're gonna love it. Danny, it is so good to have you on the show. You have such nuanced and usually contrarian views on the market. I want to get your thoughts on what is happening with silver and gold right now. We've had this sort of metals melt up, and I think you can help us wrap our heads around this.
Well, Phil, first, congratulations on the show. It's fantastic. It's an honor to be here. You're jumping right into the most volatile asset class in the world. That's great. So let's start with gold, because they're two different animals, gold and silver. I've been on the gold trade for many years, since the great financial crisis, kind of, and when quantitative easing iterations 1 and 2 and so forth. And the thought then was that if you keep printing money over time, you'll have inflation. That was kind of the gold thesis for years, used as a quote, inflation hedge. And I think we've gone beyond that at this point, as we've seen when we have periods of inflation coming down a little bit, gold's still working. And why is that? I think it's because just fiat currencies in general and the ability to print money in any global central bank, what is your kind of hedge against that and devaluing the currency? So the quantitative easing and the printing of money in Japan and the US and around the globe worked for a period of time to keep asset prices higher. But at some point, it's going to matter. And so I think that's kind of the overriding gold thesis. The thing that's happened in the last few years in gold is that the physical demand for gold by central banks themselves, look at China, how much they bought, is what really is moving the markets. And that's what's different this time. Before it was an expression of a trade, of a hedge, time. Now it's actually the physical demand. And move to silver real quick, because the same thing's happening. And I was later to the silver trade. Really didn't focus on it till last summer. So I kind of missed the first 100%, right, what was going on. And I wasn't really keen or aware of how much the metal was being used in EVs and solar. But then the real kick was AI, data centers. These huge data centers use millions and millions of ounces of silver, And so if you're out there procuring a data center and you're literally getting concrete and wiring, you're like, oh, I need silver. Okay, I'll go get it. That to me was what tipped the scales, I think, not just for me to pay attention to, but in general in the market and the mismatch. And so silver, just from a supply demand perspective, it's different than gold. Yes, it can be used as a hedge against currencies, but also has industrial applications. And you just can't switch off silver once you've embedded them into EVs and into solar and into AI data centers. It's not that easy just to switch. The architecture's been created. And so you could argue, well, copper, you can switch to copper. Sure, you can switch, but it'll take years. And the other thing I think people misunderstand about silver is you don't really mine for silver. Silver is a byproduct of other metals. So you're mining for copper, you get silver as a byproduct. So it's not simple. So I will say this before you move on to the next thing, is that owning the physical on both, or physical expression of it using a closed-in vehicle or a fund, to me is much better and smarter than using a paper, GLD, being SLV, or the miners themselves, right? You can own, because at least you want to share in a company of someone that has hard assets. So I think you got to be very careful how you express it. I think both trades have a long way to go. You definitely have volatility. You could certainly be primed for pullbacks in either, but there's nothing in either of those metals that tells me that we're anywhere near the top. So
that's interesting you say that, because I've had so many people message me saying, look, we've just had a massive first couple weeks of the year in silver particularly, and people are saying, is it too late to get in? Sounds like you say no.
Yeah, I think, listen, I like to look where things are versus where they've come from, especially on a re-rating of something. You can make that argument on some of these AI stocks and it would have been wrong, right? In terms of what is the kind of macro theme, what is the TAM, so to speak. And it's really just doing the math in silver. But there's more than that, I guess. And I'm not going to give credence to all these rumors that are out there. There's banks blowing up. People are positioning their hedge. I don't think you really know any bank's true kind of hedging position that they have. But there's definitely truth to the fact that you had margin requirements continuously go up at the CME, what you have to post. And it has gone through all of those normal Hunt brother moves they tried to make, to try to get this price. So I'm not saying it's a conspiracy or anything like that, but there certainly feels to me that the financial engineering to suppress silver won't work. And that's what I see. All the iterations of silver coming down have to do with some technical aspect of, you have to post collateral, whatever, but it's gone through all of it. So Just do the math of how much silver is above ground, how much is produced each year, and how much is in demand. And it's that simple. And if you have people that have now bought silver and demanded physical delivery, it's different. It's a different animal. So futures don't work as much as a way to express these trades as they had in the past. And so it'll be volatile for sure, but I don't think it's over by a long shot.
Does it make sense to say that the reason silver can keep running is because the AI trade can keep running?
I believe that's actually part of it. And people have asked me, what would the risk be? Well, if data centers start to get canceled and all that stuff, and just any type of sell-off in the market. We've seen what can happen to Bitcoin and crypto, just have that retail component to it. The higher that silver's gotten here, and I think the more that it's picked up some retail trading activity, if it starts to drop, it'll be volatile on the way down. That's just the way it's kind of last in, first out. That being said, it's one of the assets that I would buy on a dip. So if the AI trade were to kind of slow down, or we had some big news that there was a failed bond offering within since they're all raising a lot of debt or didn't work, sure. If you slowed it, but even then, I don't know the exact math of data center. Those data centers are going to get built, the ones that are already in progress, and that alone, silver there's just a massive shortage of it. It's just math, So,
wow, just math.
It's just math. Yeah.
What do you make right now of the AI trade and let's say some of the circular financing that people seem very concerned about right now?
So again, the macro trade is certainly here, the secular trade that's here to stay. And I think it's great in terms of advancement of technology. Again, let's do the math. Again, does the math work, right? Can you actually have that many players in it, building that many data centers, using that many chips? What is the end user demand going to be? So I think there's going to be winners and losers in the entire category, just like we saw in the .com, right? I lived through this in 99, 2000, the circular financing, the vendor financing of Lucent, Nortel, lending money to people so they could buy their products. That's not new. This rhymes. It's not certainly not the same, but is OpenAI going to make money? Like what is the end game going to be? What are they going to charge you? What is it better than Gemini? Are they going to keep up? So I think the monetization of the asset itself is still yet to be determined. Like so we know what the uses are going to be. We know the power demand is going to be, which is a whole nother issue that we can talk about, but I don't know the economics of it yet. So depending on where you sit in the AI food chain, whether just the construction and the side that's getting the power and producing it, and it's the utility side of it or the infrastructure, picks and shovels part of it. Okay. Get that. Right. If it's the software companies, that are in there, the hyperscalers that are in there building out. Okay. They have other aspects to their business. So if AI were to slow down a little bit, they'll be okay. The stocks would drop. And so I prefer to express it in a way of like Google, Alphabet, right? As a way kind of where it's a piece of their business. They're going to be around. They're the best search engine in the world. People data Gemini, So to answer your question, it's a trade. It's real. Do I think NVIDIA can sustain mid 70% gross margins? No, it can't. So is that this year, next year, year after? I don't know. But at some point, it gets commoditized, the product. And you're hearing stuff out of China, whether, you don't need as much chip power as you thought because the software can do. I'm the wrong guy to ask, but I would rather express it in a way that I pick up a piece of the AI trade without a direct thing. And so, when you start to see memory chip companies start to move like this, you're not old enough to remember. I'm old enough to remember. Those are the most commoditized cyclical things in the world. Doesn't mean that they're bad companies, but it catches up to production. You increase capacity in semiconductor land to mass produce product. So long-winded answer of do your homework and know where all the bodies are going to be. Well, not bodies are going to be buried, but where everybody kind of sits at the table. And so,
yeah, that I think that's a very balanced way to view things. And something I know you're watching, the energy side of things, the energy trade, and that is related to AI, but also I think it stands alone in many respects too. Can you tell us about this?
Sure. Well, it takes a lot of energy to power these data centers with that we know. And a lot of electricity now is generated by natural gas. I mean, we've switched over the last several years. It's almost half the power in the country is basically powered by natural gas. So when you see these moves in natural gas during this storm, and hope everyone okay out there, but you see natural gas spike. So it lends itself to being a little bit exposed to power moves. We know the grid is stretched. We know the grid needs to be built out, right? We've seen stuff out of Washington now to say, all right, We don't want this to go to the U.S. consumer on their power bills. How are we going to, okay, Microsoft needs to pick up some of the cost. Amazon needs to pick up, Meta needs, and they're doing that, right? So, but it is going to be a huge demand on the existing grid. And so from an energy availability perspective, they'll get it done, but it is one of the issues that can hold back kind of the acceleration or deployment totally of AI. So when you're looking at numbers in 27, 28, 29, some people are ignoring, I think, and then we take it a step further is nuclear. Who would have thought you'd have a bipartisan support for nuclear energy as a clean energy and underutilized? And so now you have, but again, that's a 5, 7, 10 year build out from, beginning to, so now you're getting these type of moves in other metals like uranium, right, that are happening that are going to be the source of power for that. And so again, look at the overall mosaic, take a picture, but energy is crucial in this. And energy stocks are a separate topic, which we can get into. But I guess the irony with that, and Larry McDonald did a great job pointing this out year ago. I mean, several months ago, if not years. That when you look at the technology sector as a percentage of the S&P, and you looked at the energy and the infrastructure sector below it, you can't have a single-digit percentage and a 40 to 50% percentage when the 40 to 50 percent weighting is dependent on the single-digit weighting to have them succeed. And so what you're seeing right now, which is a healthy rotation, I think, in the market as we started the year off, has been the equal weight S&P outperforming as you've seen some money kind of come out of tech into energy and some of these other sectors that are going to be crucial to kind of building this trade out. So I probably went too far and deep and took one of your questions away, but I do think it's all related and you can't just look at one thing without the other. So
some of you may not have heard this, but our partners at Public just launched something called Generated Assets. It brings AI into investing in a way I've honestly not seen before. Here's how it works. You type in an idea like AI-powered supply chain companies with positive free cash flow, or something like defense tech companies growing revenue over 25% year over year. Public's AI then dispatches a swarm of agents that can scan every single stock, evaluate them, and instantly build a custom index around your thesis. What really stands out is how clearly it explains why each stock is included. And before you invest, you can even backtest your idea against the S&P 500, so you're making decisions with real context and not just guessing. Beyond generated assets, Public lets you invest in stocks, bonds, options, crypto, all in one place. They'll even give you an uncapped 1% match when you transfer your investments over from another platform. If you want to build a portfolio that actually reflects your thesis, visit public.com/openingbell. That's public.com/openingbell. Now let's get back to the conversation. You didn't go too far at all. In September, we had a conversation for our Best Ideas Club, and I asked you, what would your highest conviction investment be right now? And the name you gave me was the ticker SRUUF, which is the Sprott Physical Uranium Trust ETF.
Correct.
It's up almost 30% since that conversation. Is that still what you're liking right now?
I think listen, I said before, back to kind of more of a macro picture. I said last year, energy stocks in general, and maybe the underlying price of oil, whatever you want to look at it. If you didn't believe we were going to go into recession, then you needed to own energy stocks. Because the only thing that was going to force oil down below kind of 55, 57 to me would be the economy really slowing down. So take that mindset, and now let's take it to the next level, uranium. If you believe that AI is going to deploy and you'll realize these forward earnings and projections that are going to happen, how are you going to power it? To what I just mentioned before, it'll be nuclear energy will be a huge component of it. You can trade uranium differently. You can trade it in the underlying miners, your CCJ being one of those. And that chart, probably what I should have picked instead of uranium, right? But they're much more volatile. And so again, now people are going to start to do the math, now they're doing how much uranium is there? It comes from 3 different countries. Can you really get it? Now you're seeing future contracts being locked in, right, over time because utilities need to make sure that they can get it. So I think from a risk reward perspective from here, I think there's very little downside because nuclear is now here to stay, in my opinion. And so you're getting more announcements, more contracts. And again, hyperscalers are literally going to build these facilities. And so money's being deployed and I think it's a great trade. So,
and what about these stocks we've seen moves like oil stocks? Is that something you're also watching?
Yeah, different reasons on that, but ExxonMobil's, as you know, has been a name I've been pushing. So it was around $100, and just felt like, again, the energy sector had been left for dead. The ESG stuff that went on for years obviously forced these companies to rely on their own balance sheet and not outside funding. And so, I always saw it like a beauty pageant, so to speak. When a stock comes up for earnings, you take a look at it, or someone, portfolio manager, hasn't been looking at the sector for a long time. You're like, hold on a second. This company has cut its debt dramatically, increased its dividend, buying back stock. No one's telling them to drill, baby, drill if they don't want to. Rig counts are at all-time lows in the Gulf. What am I missing here? And so you saw just what a move in oil from 56 to 62 did to the sector. And again, I go back to portfolio managers. I always like to just go to Boston, use the example. And if I'm at Fidelity or Wellington managing billions and billions of dollars, it's my job to outperform the S&P. That's what I do. And am I going to overweight tech, underweight tech? Am I going to overweight energy, underweight energy? And it doesn't take a lot to just get a market weight in energy. And historically, energy has been the median, weighting in the S&P is between 6 and 7%. It's been higher than that. We were hovering at 3% at the end of last year. And so to me, this is about risk reward. And meanwhile, you're getting cash returns on some of these companies while you're waiting. So to me, it was ripe and no one was there. So again, if you said, Danny, oil is going to sit at $60, these stocks have a long way to go up from here, in my opinion. All the energy stocks do. And nat gas, the widowmaker, is going to be volatile from time to time. But again, I go back to it's math, so it's bottom up stuff. What's the rig count? How much can you produce? What's going on in the Permian? I'm not an energy expert by any means. I know just enough to be dangerous on it, but I know it's an underloved, underappreciated, and underowned sector for sure.
You sound like an energy expert.
Well, play one on TV. So
yeah. Besides energy, are there other corners of the market that you think people are not paying attention to right now?
I mean, it's pretty much every other. I mean, I think there's certain areas that we see today as we sit here, healthcare, it's just, it's so political in terms of you have to worry about regulations and stuff. So policy changes on certain sectors make it certain sectors just hard. Even if you do the bottom up work perfectly. So energy is certainly one of the sector, the miners, when, you look at chemicals and materials, again, such a small part of the S&P. Just look, the reason there's such a small part of the S&P is obviously over time, other sectors have run in tech and so forth, and these haven't. So you look for underfollowed, underloved, sectors. And I think that dividend paying companies in general, if you're running screens across the board, without mentioning any on the top of my head, means that they're, getting great return on their cash over time, which means by definition, they're healthy. And you see this rotation on certain times when we get spikes in volatility. They go into names like staples, consumer staples, and so forth. So I've owned Walmart, as you know, for a very long time. So there are just, and that's obviously not underowned, at this point, but you can find a lot of underappreciated sectors, and then the names within them, try to find the best ones. And that's kind of, so they're all over the place, to answer your question, but you want to kind of avoid sectors where there's stuff outside of their control in terms of policy changes and so forth. So,
I think that makes sense. And I see a lot of people talking about this broadening out this year, like more than last year. It's going to be less tech heavy. It's what a lot of people tell me. And it sounds like if there's opportunities everywhere, you're also falling into the camp of this market is broadening out. Is that right?
This is the healthiest, call it a flat, not a flat market, but it's not up that much, obviously, for the year. I don't know where it is we sit here today because it's up again. I know we're at record highs, but that's a very healthy thing. When you can have these, tech volatility, and we've had a lot of moves, but money stays in the market. I also think that what you need to watch is rates. And, bond yields are 10 years are hovering around that 420, 425 level. And I said a few months ago that 4.5 is the new 5 in terms of where people thought, oh, we're okay as long as the 10-year yield doesn't get to 5. I think it's 4.5 at this point because of direction, because inflation has come down a little bit enough. But if we get back to 4.5% 10-year yield, I think it does change the dynamic of how people kind of view the markets from here.
Can you explain that a bit more?
Yeah, I just think that, so we were worried about what would be the reason that rates would go back up. The healthy reason would be economic growth. Like good. Mm-hmm. I don't think we'll have enough economic growth. So back to your question of why is the S&P broadening out? I think, first of all, the time of year is always ripe to find new ideas and take risks early in the year. The valuations are very full on these tech companies. You can love them and hold them and not sell them, But to get incremental dollars coming in them, you kind of need the next leg of margin expansion. So we'll see. We're right in the middle of earnings season here. We're going to get a bunch of them in the next few days, right? So I don't want to jump the gun on any of it. But I think there's more excuses to sell some of the high flyers and excuses to rotate and buy. And that's a healthy thing. And I think that was underutilized and underappreciated in all of 2025 for that matter. And it has been a stock picker's market for the last 3 or 4 years of underfollowed, underappreciated names. And sometimes you need some type of catalyst to get them going. And sometimes it's just eyeballs, that come on certain names. And so I think it's healthy. And I think it's bullish, actually, to have that money stay in the market. But back to the point on the bond yields, 4.5, there's a lot of debt in the system, okay? And most of the debt in the system, which I know we're going to get to, is sitting at the U.S. government. And so that's so crucial because everything is predicated on the U.S. government's ability to keep financing itself. And again, back to gold. All roads lead to gold. But that's why it's not just the corporate impact that it would have. I think it's more treasury impact on the U.S. government. So,
can you explain a bit more why you think the government debt is such a problem? Because from my
back
amateur,
to math 101,
give me the math. I see it as, look, the government it's never going to let itself default, and that might be an amateurish way to think about it, but they can just change the ceiling or change the equation they use to get to certain conclusions. How are you thinking about this?
I mean, at some point, listen, so what you're asking is, can you really trade the end of the world? And so you don't want to even think about it because what's the point? Why you can't trade your portfolio as if the US is going to default. Okay, you're 100% right. But let's just do the math for a second, okay? Approaching 39 trillion in debt. The current debt ceiling is 41.1 trillion. We'll hit that in 2027. We're running a $1.8 trillion annual deficit, right? So where can you cut? $1 trillion of that goes to interest costs. 1.6 goes to Social Security. You got Medicare, defense spending. 75% of the spending that goes on is mandatory, unless you're thinking about cutting Social Security, Medicare. That's a whole different issue. That's not going to happen anytime soon. And so that's math, right? So we're going to grow that. Can you grow your way out of it? Okay. Can you GDP be enough for your economy to be able to do it? I don't think so. Not enough. Can it certainly go to a $1 trillion deficit? Maybe, but you're cutting taxes right now. And so just math and balance, and whether that's pro-business, which it is, and whether you think that that'll end up working its way through the economy, maybe. I think you're playing with fire. And that's the reason I say that if rates were to start to go up. So what are we doing in response to that? We're issuing more short-term paper, right? We've seen that. Essence going, or, issuing more T-bills, right? That's the strategy. That's fine. So the game here is that get the Fed to lower rates or go into a lower rate regime, which can stave off a lot of the stuff and lower interest cost over time. Certainly, again, you can't control the long end of the curve. So if the long end of the curve decides that it wants to move higher, there's not a lot you can do. Yes, another round of QE will announce, we'll start buying. So again, we're talking, and as I'm saying here, all roads lead to gold. And so, yes, they're going to pay their debt, the U.S., yes, over time, but your debt to GDP, if you want to calculate just total debt or just, outside owned debt is 30 trillion, 31, the internal is 7 or 8 trillion, whatever method you want to use, we're over 1-to-1 debt to GDP. And the last thing I'll say with this, which ties in, is look at Japan, which owns $1.2 trillion in U.S. treasuries. Why are we so concerned making daily calls to Japan? Why is the New York Fed watching their currency like a hawk? Why is Bessent talking to them right now? One, because we don't want them to sell our paper to defend their currency, right? So you're now dependent. So it's not just us. So there's a global mechanism which goes back to 2008 again. And so it's not us. On a relative basis, we look great next to Japan, but if we're not careful, we're going to head that way. So that's kind of my view.
Is there any way to, let's say, trade this
end of the world?
Yeah, end of the world.
Gold.
I mean, is that the only
No,
trade?
but gold's been absorbing all of that. So look at the US dollar. Under talked about, underappreciated. People think risk on, US dollar down, good. People buy our goods, good, it's great, it's great. That's great when you don't have a lot of debt, you're not dependent, and you don't want inflation. Lower currencies spur inflation. Period, end of story. A cheaper US dollar could increase inflation. So there's a positive and there's an offset to everything you see. It's economics, math, 101. And so I think there's so much going on in the macro between tariffs that It's just focus on earnings. And maybe that's the right thing to do, is just do your bottom up work, and hopefully all this other stuff works itself out. Because again, if you go into your boss's office and you're an analyst at a money management firm, like, we're going to default on our debt. Great. Well, you're fired, because if you're right, our money's gone, because no matter how we do, our clients that are putting money with us. So again, it's counterintuitive, and no one wants to think like that. And that was 2008, a little bit of that. It's like, how do you see something coming? And if it actually happens, and you saw what can happen just from, within the system when something is not paid attention to, or the belief that, Bear Stearns can never go out. You know how many times I heard Bear Stearns can't go out of business? Thousands of times in the year leading up to it. Lehman will be fine. There's not going to be an issue at Lehman. So again, we've shifted kind of the risk, so to speak, to the government balance sheet, which I think is creating a false sense of security that everything's going to be okay. So you got me all bared up. I'm not even that bearish. I'm just, but the more I talk about this stuff out loud, anyway, buy some more gold. Is any of this stuff gold? Anyway, go ahead.
Okay. So Danny, something you've told me before about 2008, you said, once you've seen the end of the world, financial world, it's hard to unsee it. Do you see that right now? Is there anything that you're looking at that screams out, this feels like 2008 again?
I think, well, to go back to your point, there's a PTSD for, actively trading money in that environment, and then you can't ignore it. Once you see that happen, you know what's possible, how things can go really wrong. I think I just mentioned before, I think the risk now isn't in the banking system. It's outside the banking system, and it's on government balance sheet. So what's happened in the last 15, 20 years has been the absorption of corporate debt onto the U.S. balance sheet. It didn't just disappear. Through quantitative easing and TALFing and TARPing and all these things that have gone on, we have become reliant. In fact, there's a generation of traders and generation of people, including yourself, that were born into an era of the Fed has your back and created this moral hazard, for better or for worse. I'm one of the people that saw what can go wrong. And there's people that are older than me that saw other cycles that can go wrong as well. And so you have to acknowledge it. And if you acknowledge it and incorporate that thought process anywhere into your brain with what's happening, it's kind of always kind of there. And so there are some similarities. I think private credit, it'll muddle through. It'll probably be okay, but we're not able to monitor like we did in the bank. It's not in the banking system, so to speak. So if credit goes bad now, it won't take down the system, because these aren't government insured entities. But you can bet your bottom dollar they'll bail them out if it does happen. That every private equity or firm, and I think the PE companies themselves are going to be okay, right? But private credit, if it does have a downturn, why can't we just do another TALF like we did back in so I guess that thinking allows people to ignore it over time. But make no mistake, there's leverage in the system, and a lot of it's sitting in the U.S. balance sheet. Again, what do you do in that case? You've got to own a little bit of gold. I hate to keep going back to it, but instead of buying puts on the S&P and trying to time when the market's going to sell off as a result of these things that are happening, gold's absorbing it, and the dollar's telling you. So dollar debasement, gold going higher are the two indicators to me that are telling me the PTSD or what can happen and what could go wrong. You're just ignoring kind of the markets in general. So there's just a lot of mixed signals that are out there, in my opinion. So.
Real quick, we'll get right back to the interview. Just wanted to pop in and say, if you like this content, I write a newsletter every single morning called Opening Bell Daily. I cover macro, the stock market, asset prices, why things are going up, why they're going down. And if you want to get that for free, you can sign up at the link in the description. Let's get back to the interview. Someone my age, or even my own personal perspective, it's very hard to believe the Fed or even the president will not stop a bear market at this point. They've provided, this environment where it's just very good for asset prices. And long-term, there are probably repercussions of that are negative. How do we shake out of that mindset?
That is the mindset. It's not you. So that's priced in to the markets right now, to your point. And it's an election year. Midterms are obviously very important. And so you've already seen a very pro-consumer, pro-housing affordability. So to your point, yes, I think you're 100% right. But that's the embedded put option, the Fed put that's sitting there. And that's why, whether you care about Fed independence, I do. Whether you care about the Fed in general, that's a whole different discussion. Again, if you start to sense that and the government does things, that means they're absorbing more and more risk. What does that do to our debt? What does that do to our rates over time? if you can get away with it and manage through it, kind of bob and weave and trade, I guess it can work. But I'm just not built that way. And for better or for worse, God bless the people that are and can ignore it. And the amount of money, to your point, being pumped into the system, and it's still being pumped in, let's not kid ourselves, finds its way into assets. And that's the market, and that's liquidity. So ETF flows, retail, don't stop. They just don't stop. And so until you see that stop, to answer your question, that's going to be the mindset. And so for better or for worse, that's what we're dealing with. So
it's very hard to find someone who is under 35 who is bearish, because I think we haven't lived through something so.
We have a couple of analysts that we trained at our hedge fund. They're running around, not even speaking at this point. But yes, there are the under 35s. I know all 5 of them, by the way. Yep. But anyway.
Yes. Yeah. When you go through something like, successfully betting against a housing crash, as you did, how do you emerge from that and then not turn into a super bearish investor?
I think, again, recognizing what can go wrong is, for anybody managing money, obviously that's part of the process. What is my risk reward? What discount rate am I using, to kind of look at this? And so you learn from it, you put it in the back of your mind. It's almost like being a coach in a sport, right? Where you think, oh, okay, I know what we're capable of, I know what we're not, I know what our strategy needs to be. I manage the game a certain way, right? And so I think everybody has a different type style. And I think what you saw, financial crisis, was a lot of people that were prop trading with bank balance sheets. What did they have to lose? If they were right, they got a huge bonus. If they were wrong, they got fired. So again, and that was before the Fed was coming, but I'm saying it was set up. So what are the incentives out there for certain people that are managing lots of money, right? So you have a lot of thoughtful people that are money managers that are kind of out there. But, for me, it will always be difficult. And it's a blessing and a curse, at the same time. And I think that you apply that methodology, though, to other sectors and other names and valuations. I'll bring it back to energy again. I always look at what can go wrong before I look at what can go right with the name. Like, okay, so if oil goes to 40, what would happen to this energy? And so once you have that that's just how I do things, bottom up, risk reward. And so to me, I use it like that, which means I have a very hard time dreaming the dream of certain things that are out there, right? Of the AI trade going to, or NVIDIA maintaining 75% gross margins in perpetuity. Like I can't, that's just very difficult for me to just, so I like to think as a contrarian. Our Substack with Vinny and Porter is contrarians at the gate, think that way. And then from there, when I like something, I tend to think that it will, potentially, that I pre-screened it for people to a degree, right? Because if it got through my look, then that I've tried to find the negative in everything that I can. So, but I'm an optimistic person. So don't think, Phil, that I'm, so negative.
No, I know that.
Yeah, so yeah, exactly.
Yeah, it's, no, you have a very, I'd say complex worldview, I think, because some of the things you say sound very bearish, but I know you personally as an optimist. So it's like this interesting balance you have, and you obviously bring that to your trading and your investment philosophy.
Yeah, listen, I'll sell too early on the way up on something, right? But you never go broke by selling early, right? And I think if you apply that into not being shaken out of a name that goes down a lot, if you're confident in your theme and you can handle that drawdown, that's huge opportunities. And so it takes a lot. I'm the last one to kind of meme something, right? I won't jump on that train, but I also recognize the liquidity in the markets and what can happen in certain names that can run much farther than you think. I mean, being short a stock, your risk is infinite. Your risk is bankruptcy. Long a stock, your risk is just the money that you put in. So that's, again, back to math. A lot of this comes down to math. So it can only lose what you put on the long side. Infinite losses on a short. Infinite, because it can go to, there's no top.
So we're sitting here, start of 2026. You're probably the best person in the world to ask this question.
I'm sure not, but go ahead. Yeah.
Is there another big short to look for right now?
Again, every era has its sector thing that can happen and go wrong. I was in the .com trade, right? I lived through great financial crisis. And now what are we experiencing right now, right? There's always a trend or something of the day. It was .com, it was mortgages, it was, you can refinance your house forever and your rate, they're going to be paying you to live in your house. I mean, literally that's what, even to now, what is it, this AI trade? And so again, I think there's a lot of ancillary things that are related to the AI trade that are probably being underappreciated in terms of, and I would say this differently, the wealth effect of the U.S. markets has never been higher. I think the market's going up, feed on itself for the economy. I know that's maybe an obvious statement, but I feel like never has retail been this involved. Never has there's been this spread of ownership of the markets. That if you did get a drawdown in the market, so again, it's different. I think it could feed on itself to a slowing of the economy, and a slowing the economy could feed on itself to lower GDP. And then this debt conversation we just had about how do you finance deficit all kind of changes again. And so it's just different. But yes, there's risks out there. Yes, there's credit underwriting that's lax. It's not in the banking system. Debt covenants are very lax. And if you have a cycle in the economy, when the tide goes out, a lot of stuff will be there, but it's not going to be not going to be as big of a contagion as it was, but it might feel bad because the markets could certainly come down a lot on that kind of wealth effect and feed on itself. So I don't know if I answered your question. So every cycle is different, but they all rhyme. So
fair enough. Do you think that, this is a bit of sidebar, the easing financial regulations, is that manipulating markets in any way, or is that raising the risk?
It might raise the risk long term. I think we've priced that in. There's a reason banks are trading it historically. When you see banks go from multiples of tangible book and ROE to validate to PEs, to price to earnings ratios, you can't meme a bank stock. So you see now the JP Morgans and the Goldmans of the world, right? Kind of they're priced pretty close to perfection, in terms of that. And part of that is the regulatory environment and listen, some of the regulations were too stringent, certainly on the local and community banks, I think to a degree that, had shared a burden that they probably didn't need to over time. So there is a part of it, but they'll give, in a deregulating environment, they'll always going to be more leverage in the system than it should be. And that's just, again, human nature. You find me the people that are making money and how they're getting paid and the risk reward for them being wrong or right, and I'll find you where there's going to be potential issues in the market. And so it'll have consequences a little bit, but to answer your question, I think that's priced into the market. That's been pulled for. The regulatory environment's going to be better in every category, in everything you look at. So I'm worried. Here's what I'm worried about. I think that non-investors that are consumers, right? So just, consumers out there and that aren't invested in the markets, that are cheering on deregulation and all this stuff just for the fact of that's what they want to happen, don't realize that they're the ones that become more vulnerable when the SEC and the DOJ, this is not a political statement, this is just the truth, that are and the CFPB is dismantled, the Consumer Financial Protection Bureau are not looking out for you, and businesses garner more power over the consumer. That'll have consequences, maybe not for the stock market, but in the long run for how, U.S. consumers and stuff need to watch out for their, for themselves. And so, when you deregulate and you take off regulations, at some point, somebody goes a little too far. And by the way, the flip side's true. When there's a crash in the market or something, too much regulation comes in. So we always tend to sway both ways, and it always tends, find its way back to the middle. So,
wow. So Danny, you are more active in media than I am. Okay. Yeah. And I want to talk about that for a minute. Can you tell us about...
I'm not sure how that happened, but yeah, how this all happened.
You're prolific in media. It's unbelievable.
Yeah.
Can you tell us about what you're doing with your team and then the two shows that you're hosting as well?
Yep. So Porter Collins, Vincent Daniel, and myself started a Substack last August called What Are We Doing? Contrarians at the Gate. What are we doing was what we always said to each other on the trading desk every morning. Like, what are we doing? Certainly during GFC as well. And so we decided to turn that into a Substack community, and, it's been amazing. We have over 5,000 members, many of those paying. And we write at least a note a week. Vinny is the writer in the group, obviously. And we do a podcast every Friday called The Friday Night Dirty, which is a summary of what's happened during the week or something that we see that no one's paying attention to. So that's been great. I launched the Danny Moses show on Scripps Network last week, 30-minute show, broadcasts on Scripps News and on YouTube, and then on some of the local channels that they own across the country. So that's fun. That, it's again, 22 minutes of content or 24 minutes. It's hard to pack it in, but I try to do that. The On the Tape podcast is still going. I think it's going to morph into something else. I think it'll be interesting, less interview format. So I've kind of moved the interview format like this over to the Danny Moses show. Hopefully you'll come on at some point. And so listen, I love talking about the markets. I'm going to be wrong. Certainly from time to time, I'm not shy to share my thoughts or opinions, and they're just opinions, right? This is not, and listen, the markets are amazing. I've had a passion for the market since I was 8 years old. And I think I told you this before when you and I interviewed, is that I was going to be a sports broadcaster before I kind of found Wall Street. And the reason is I'm passionate about sports and I love to talk about them. And so kind of, you'll see some sports talk on the Danny Moses show from time to time. So anyway, it's just a passion, and I'm still actively kind of managing just my own money, nothing crazy. And so I'm having fun with that, enough to stay interested in the game. So
would anything ever pull you back into real, like full on Wall Street again?
Never say never, but I feel like once you kind of move into media, it's very hard to kind of come back. Not for any particular reason, other than you're known for maybe something else and what you're worth, but never say never. So I have such a passion for the markets, but given the right opportunity, listen, Vinny and Porter have basically turned our hedge fund into just kind of family office. And I've never seen them happier. And to not have to manage outside capital, to have no concerns about any type of duration, about drawdowns and so forth, being able to do that. And I'm not going to give away, they tell you what their returns are, but they're very modest. They still write a letter. They're up a lot in the last 4 years. And so I guess I'll never lose that zest for finding those type stocks and hearing those ideas. And I think Substack, not just our Substack, but Discord channels and other things have changed the way I think that people have find their information to invest. I won't destroy Wall Street research on this show here, but we know that it serves a different purpose and a different function. So again, it's like, gold mining. Back to gold, always back to gold.
All roads lead to gold. Danny, I can't tell you enough how much I appreciate you coming on the show. Learned a lot, and we'll do it again soon.
Well, Phil, I feel like you're the Terrence Mann in Field of Dreams. You're the voice of the next generation, so to speak. And so keep up the great work and write what you're seeing and keep it out there, because I think your wisdom is beyond your years. So thanks for having me.